Hello friends. So today we will have some information about options trading. So the first question which came into our mind when we listened to options trading, it is very risky. Yeah, though it is a little bit risky, but if you have enough information about option trading and even if you know chart reading and if you know market, then it is not that risky where you lose all your capital over it. Though no one is perfect in market, we can have our assumptions, but we're not sure that we are 100% sure. So it's a little bit risky, but if we are used to it and if we have good knowledge about chart reading, the market, the fundamentals, then we would earn more in options market. Okay, so we'll see what is options trading. So the key terminologies which are used in option trading, you might hear a lot: the stock value, the strike price, premium value, what is intrinsic value, time value, lot size, call, put. So we'll go through everything. So we'll see what is stock value. So here you can see that I have taken an example of Lupin. So currently Lupin is trading at 814. So 814 is the stock value of that Lupin. So it is the present value of any stock. You can take any example. If you take an example of Ashok Leyland, it is currently trading at 132. The stock value currently which it represents, that is the value of the stock. And what is the strike price? So in options we have concepts of call and put. So considering we are checking about the call, so here I have shown you one example about Lupin, all the calls which are available. So I have taken few of the calls. So here we can see that this is the strike price, 780, 800, 820. So means we are trading at one of the strike price. So currently the stock value will be 814 while the strike price will be 780, 800, 820 depending on the call or put which you select. So every strike price will have its own premium value and all that we'll discuss further. What is a premium value? So here you can see for Lupin, for call for 25th of February 2018, for strike price of 800, it has opened on a premium of 25. It has made a high of 25.95. It has made a low of 14.55 and it has closed to 70. So what is premium? So premium is basically divided into two terms. One is intrinsic value, next is time value. So in options we deal with the premiums only. We are not investing directly to the stock value. So considering we are taking an example of Lupin, currently it is 814, but we are suppose checking for the strike price of 800. So 800 will have some premium value that is pre-calculated. So how it is calculated? So suppose I am buying a stock premium, I am buying a call of 800 for Lupin. So on start of the month it would have a value. Suppose we have a value as 50 and the stock is trading at 810. Stock is trading at 810 and we are having a strike price of 800. In this scenario, the difference between this current value and the stock value will be the intrinsic value. Means the stock value is 810 and the strike price is 800, then the difference is 10. So 10 will be the intrinsic value. Then what else is the rest 40? It is the time value. As we are getting a whole period of 22 days, if we are considering it a Feb month. So Feb has an early expiry of 22nd Feb. So 40 will be the time value. Okay. So this is how the premium will be decided. So in next of the slide, I have described furthermore about this intrinsic value and the time value. See, I've given the same example of 800 call for fixed expiry, which was open on 25. Now 25 is calculated from intrinsic value and time value. So here we consider 813 as the stock price, then 13 would be the intrinsic value, and the difference between the stock price and the strike price, that would be 13. So that would be our time value. So time value will always change from start of the month to the end of the month, so it is a decaying value. So at the start of the month, the time value will be maximum, while at the end of the month or on the last day, the time value at the last moment will become zero. So whenever we are trading in options market, keep in mind that whether our stock price will change or not, but this time value will change. So even if we are taking a call of 800 and the price of the stock is 810, even after 10 days the stock price is the same, but we have decrease in time value, so that is why our premium will decrease, and which will result in the loss. So what is lot size? So every stock has decided its lot size. For Lupin it is 600, for Ashok Leyland it is 7000. So what actual the price which trader pays for a single lot? So for a lot, it would be, for suppose we are checking for 800 call. So what investor needs to pay is, the trader needs to pay is the premium price 25 multiplied by the lot size, that is 600. So it would be 15,000 for a Lupin 800 call. So this totally varies at what time you are buying, whether it is in the money call, out the money call. So the premium is decided on that. So we'll check about what is call. So call is when we are in a buy sentiment about the stock, and we feel that the price of the stock will go up. So suppose we are taking a call of 800 for Lupin, and it has a value 810 currently, and we are expecting it to rise. So we are expecting it to go to 830. Then in this situation we will buy the call option. Or suppose we are in a negative sentiment, then we would buy a put for that. So even call has three types. It is in the money call, out the money, and at the money call. So what is in the money call? So if we have value of Lupin currently as 810, and we are buying a call at strike price of 800, so means currently we have strike price of 800 and the stock is 810, which is greater than the current strike price, right? So in this case, our strike price is 800 and we are already in a profit as the current price is 810. So we are currently dealing in profit at the time of buying. So the premium will be higher in this case. It is the in the money call. And suppose if we are buying a call of 820 and the stock price is 810, so this 820 price is more than the current price, which is 810, means we are already in a 10 rupees loss. It is not an actual loss, but we are buying at a higher rate. So the stock which has a capability to reach 820, it will take time. So this would have a low premium because we are buying a stock which has a value of 820. So currently we are not in profit. So once the stock comes to 820, then our premium will rise. So once it reaches 820 and it goes further 820, then the price of the premium will move faster, as we have seen this in earlier this premium value calculation. So intrinsic value will move fast in this case, while the time value will not move in the same variation, but the intrinsic value will move fast when it crosses 820. If we are in the out money call, or even if we are in the money call, the premium will rise faster. And at the money call is buying a call which is currently at the same price of the stock. So the strike price and the current price would be same. That is at the money call. So even for the at the money call, the investment is greater. Even for the in the money call, the investment is greater. Even the profit and the loss is greater. While for the out of the money call, the investment is less, the profit is less, and even there are chances of losing the money are more, because if we are buying a call of 820 and if the stock never touches the 820 in the current expiry, then at the last moment there will be zero intrinsic value, and the time value will also become zero, and the total money invested will be lost. Then we will check for the put. So put is when we are in the sell sentiment about the stock and we feel that the price will fall. So it all totally depends on the chart reading, the market condition currently it has, the fundamentals, the growth of the company, and everything that we have. So even the put has in the money, out the money, and at the money options, just it is reverse of the call. So as we have a buy and sell options, here also in option trading we have a call and put. So suppose we have a sell sentiment for that, for the in the money call, suppose for Lupin it is currently 810 and we are buying at a price of 820. So we are selling it at a price of 820. That means currently it has gone to 810, means we are already in a profit of 10 rupees. So the price of this put will be higher, that is in the money call, because the strike price is 820. It is reverse of that call. So from 820 it has gone down to 810, and as we are in the sell sentiment, we are already in a 10 rupees profit, means the premium will be higher. And even if it goes down to 800 or from 810, how much it goes downside, the profit will be maximum. Even the investment will be more in the money call. While for the out the money call, if we are buying a put for a strike price of 800, so in this situation we are not at a position where the stock will reach to 800. So 810 is the current Lupin's stock price, while we have bought a put at 800 price. So Lupin has to reach 800 so that we will be in a good amount of profit. So once it goes down to 800, we'll have a good profit. So it is out the money call. So currently we are expecting it to go down. So until it reaches 800 and it goes down to 800, from the 800 we'll have a good amount of profit, as the intrinsic value will move faster from this value, as it would be the difference between the stock price and the strike price whenever it goes down to 800 in case of put. While in case of call, if we are buying a call of 820 and the stock price is 800, when it goes above 820 we'll have a good amount of profit, because the intrinsic value will be coming into play. So currently intrinsic value will not be present if we are buying a call of 800, sorry, the put of 800. And for the at the money, it is similar as the stock price and the strike price are the same. So even for this, the premium for buying is more, and even the profit is more. And so in options we have a fear that our capital will lose. So the loss is limited in options. So suppose we have invested 15,000 rupees and we have taken a call of 800 and the current price of the Lupin is 820. So when it goes to 840, our premium from 25 it will go up to 35 to 40. So we'll have a profit of around 15 premium. So 15 premium profit means 15 premium into the lot size, that is 600, that is 9,000 profit we'll have. So in this way it is calculated, but the loss is minimum. Loss would be 15,000 only, and while the profit, if it goes suddenly 5% up within a week, then the 25 call will become 45 to 50. So the profit is more than the 15,000 which we have investment. It would be 100% in some of the cases. So this way options trading happens, and if we have a good knowledge, if we are in a touch with these options and we are following a stock, we have a good knowledge of chart trading, then we can earn some good money in options, though it is a little bit risky. Thank you, friends.